Welcome everybody to episode 44 of Martinis with Scott. I know what you're saying. You're saying, Scott, last week was not episode 43. Yesterday was not episode 43. We were down in the 30s. What happened? This isn't rolling forward for me properly. I know, as an accountant, I break into little tiny hives when things don't reconcile. But there's an explanation. The explanation is we're changing the numbering system. When we started back on this show, we had the Martinis with Scott concept, which was to be a discussion with guests. Then I wanted to provide you more content. So I started doing quick shots, which were short technical topics, and like tangible net worth has been a popular one. And so we branded those separately and started counting them separately. And now I'm just even trying to provide more content by doing maybe 3 a week of a daily show. Maybe that'll expand to 5 depending on my how these are going and what my time is. So the bottom line is the counting's all over the map. So what we've done is I've said, the hell with it. We're just going to call these episodes. So we figured out we've done 43 videos today of all sorts of, Martini with Scott, quick shots, things that fall in between. This is episode 44. We're no longer going to separate them, and we're just going to count episodes from now on. So hopefully that relieves you of your roll forward reconciliation stress that I'm certain that I was feeling. I know I was, and I'm certain Olga was, and other people that are following along on this. Now, an important programming note. Happy anniversary to Martinis with Scott. I made myself a martini to celebrate this. 1 year. We started this on March 4 of 2019. Ashley and I went to the National Club on Bay Street in Toronto with a system and tried to go live on Periscope, which what we called episode 0, and it's still on YouTube right now. And that's when this all started, and it's been an interesting year. We've learned a ton, and the show's getting more and more following every day, and I'm excited to push forward with year 2. So here we are, episode 44. Cheers. So Martinis with Scott, a show about winning at business for management, investors, directors, anybody associated and interested at winning at business. This is the discussion geared to you. So interesting today. So yesterday we're going to talk a bit about contractors versus employees. And yesterday there was a court ruling in France from the appeals court, which ruled that a former Uber driver is to be recognized as an employee, not a contractor. And that court case it can't be appealed any further, so it's final. And so Uber lost, and this guy from years ago, this driver has been ruled a contractor. It's the first ruling of its kind anywhere in the world. There's current litigation going on in the US, all over California, I believe, UK, on a similar issue with Uber. The company won a case on the exact same issues in Brazil, but it's a worldwide issue that Uber and a number of other tech companies and modern generation companies are having to deal with. And so if you want more on this case, I picked this article up in the Wall Street Journal this morning. You can look it up. I'm sure there's a bunch of other sources for it that don't have the paywall that the Wall Street Journal has. But it raises an issue that we deal with in business every day as entrepreneurs when we're starting companies, as we're starting new initiatives within existing companies that have been around for a while, is you hire somebody to do a job. Are they a contractor? Are they an employee? What's the difference? Does it matter to you as a business owner, manager, investor, etc.? So in the article in the Wall Street Journal, they presented this as a gig economy issue. So I don't really know what this gig economy is, but the issue is when companies are providing on-demand services, so they have an app that's providing an on-demand service like an Uber, and the individuals that are providing that service, are they contractors or are they employees? And the key to this is if there's no demand on the app, that person's doing nothing. They're off doing something else. So that's the issue. And there's huge financial consequences for both the employee or the service provider in this case, and the contractor or the employer on the Uber side of this equation. And again, this relates to many other companies. We even see it as a regular discussion in my portfolio of companies. It's something that entrepreneurs need to deal with as I said, I think on a daily basis. So the French ruling relied on the fact that Uber sets its routes. So it's rates, it's routes. If you picture the app, the route pops up, which is driven by Uber, if you forgive the pun. And so Uber has control over that, and they can sanction the employee / contractor if rules are broken. So the concept, I think, in the French term was submission, that Uber has control and power over this driver, and the driver submits to those controls and powers and is therefore an employee relationship as opposed to a contracting of equals. I assume, I'm not a lawyer, I'm not trying to give you legal advice, I'm just going to get to a point on the business side of this. So the first thing that creates in my mind is a question about what is the difference then between a contractor and an employee? Because if you think about a taxi driver, for example, who's clearly a contractor in every jurisdiction that I'm aware of, it would be a competitor to Uber, as the taxi fellow sits around with a license issued by the government. The rates are prescribed by the government, so it's a set rate, same as Uber. The routes are regulated, right? So they may not have an app that pops up in the taxi cab that says you got to go this way, and that way. By the way, if you're watching on the podcast, I had my fingers going on screen there to demonstrate where the route goes. But the point being, they may not have an app that says that. But if the taxi driver takes a weird route, certainly the rider has an ability to complain to the regulatory authority, and there's going to be point number 3, sanctions. So as a taxi driver, there's all sorts of rules that the government imposes on you, and if you break them, you're sanctioned. So the government sets the rate. The government regulates the routes. The government is able to sanction you. I don't see how that's different from Uber setting the rates, setting the routes, and sanctioning you if you're offside with their rules. In any event, that was the ruling of the French court. Now, the Uber's counter-argument, which they lost on in this jurisdiction, but they won in Brazil, is that the drivers can log in and they can work anytime they want without restrictions as to where they are when they work, when they're going to work, and even if they're going to work. Maybe they don't show up for a month. Employees don't do that on a regular basis, as you know. So the definition of what is a contractor and what is an employee varies from jurisdiction to jurisdiction, and depending on where you are, you probably need legal advice or at least some sort of research into this issue. Right, so if you're hiring somebody, right now we've hired somebody in Colorado to come in and build some machinery for us. They're going to be around full time. It's probably going to take 6 months to 9 months. This is in a hemp processing facility. It's going to take a bunch of time. Is that person a contractor or is that person an employee? And everybody wanted to hire him as a contractor. I insisted as the director of this thing that they be an employee. That some of these people would be employee, and I think one person we made an exception for unique circumstances to be a contractor. But there's real consequences, financial consequences, as I said, to the company in making that decision. So in common law, again, I'm not a lawyer, but you're going to look at control as one of the determining factors. So, and this is really the submission issue from the French ruling. Who is the ability, authority, and the right to control the actions of the worker, including how much they work, the nature of what their work is, the location in which they work, the management of that work, and that really boils down to control. And that would be one of the tests that you look at to decide whether your worker is an employee or a contractor. You look at the economic reality, and this test comes down to who is taking the financial risk. So in an Uber situation, I always wonder if the driver doesn't have any demand, then what is that person doing? I mean, they're sitting around on the curb day trading. So the driver is taking the economic risk of that and not Uber, which to me speaks about being a contractor, whereas if you were on salary, the economic risk of that demand would fall to Uber quite clearly. You're going to look at organization integration issues. Does this person show up to your office every day? Do they have a key and a pass card for the office? Do they have a desk? Or how does this employee or worker relationship work with the organization within their working? So it's a test of a bunch of different factors. And at the end of the day, the government, being the revenue collection body, the IRS or CRA in Canada, is going to apply that test. So they're going to make their judgment, and then they're going to come down more often than not that this is an employee, because that's where they get the most taxes. And then you as a company need to fight that and make your case. And this has just been a hot issue for a decade that I can think of. Now, what are the consequences of this person, this service provider, becoming an employee rather than a contractor? Well, the provider of the services as an employee suddenly becomes eligible for employee benefits. So that would include things like healthcare, for example, sick days. They would be entitled to paid vacation. They would be entitled to minimum wages. So how does that work with an on-demand service? The Uber driver in the French case apparently will now be seeking back pay and severance. So as an employee, you would be eligible for those sorts of things. As a contractor, you would not. The employer, if this person is deemed, or any person is deemed an employee, had a responsibility to withhold tax, payroll taxes, to remit those payroll taxes, to add on to those remittances, those withholdings, a contribution to pension and to employee insurance plans. So there's a gross up element of that. In total, completely depends on the jurisdiction, completely depends on your benefits plan and insurance plans of the jurisdiction. But from the employer's perspective, having someone be an employee could add up to 20% more compensation, cash out the door, not compensation to the employee, but 20% more cost for that service provider if this person is an employee rather than employer. That's just a ballpark number. It changes by jurisdiction. It could be higher, it could be a little bit lower, but the point being, it's a significant bump in the cost and in difficulty in holding these funds back from pay, keeping them as what's called a deemed trust, and then remitting those funds. People would rather just avoid that if they can and have a contractor, particularly entrepreneurs who are just setting up their business. They have no idea how to pay payroll and be compliant and all those things. But the risk changes when they become an employee. So this 20%, to me, that's your best case scenario. Now you think about Uber and you think about all these drivers sitting around at minimum wage with all these employee benefits, and there's no demand at that particular moment, and they're just sitting on the side day trading. Well, what's happening? Are they getting paid anyways by Uber? How would Uber or any other on-demand app be able to afford that? And what is the cost to the consumer? How much of that is going to flow through? I think it's just going to be horrendous, and it's not a sustainable model. And then also, if you're deemed employee by your revenue agency, if your employee base is deemed non-contractors and employees by your revenue agency, there will be retroactive penalties, interest and fees to the employer who failed to disclose these contractors as employees, and those can also be significant. It's an interesting issue because this is governments. The issue is governments who are focused on taxes and old school union style protections for employees, fighting the new economy, the tech economy. They're fighting speed and flexibility. And I think at the end of the day, speed and flexibility are going to win, but it's going to be a long, drawn out battle. And there's going to be millions of businesses that are caught up, and it happens every day, that are caught up in this battle and have these costs. So why is this an interesting business lesson? Because it happens all the time. And if you're starting a business, or if you've built a business based on contractors, you need to consider the risk. Do you have a sustainable business model if these people are employees? In other words, what if your costs go up 20% for HR? What if they go up 40% for HR? Is your model sustainable? And also, is it scalable? Because every jurisdiction you go to is going to be different. You look at Uber, they're dealing with lawsuits in California, in New York, in the UK. This was a French ruling, yet they won in Brazil. They're all over the world. And every one of these jurisdictions has different tests. It's all sort of the same issue, but they have different tests and different legal considerations. How scalable is that without a huge amount of overhead being spent on lawyers and compliance and all that sort of stuff? All right, so contractors versus employees. I want to talk about that today. Also interesting to me today, or last couple of days, was more chaos in cannabis. And I'm going to look at Cronus 2 days ago. I don't know a lot about this company. I haven't done a deep dive into it, but cannabis is just getting wiped out again today. And I think it was 2 days ago, Cannabis noted that they're not going to file their financial statements for this quarter on time. And quote, in the press release, it says, quote, there's several bulk resin purchases and sales of products through the wholesale channel and the appropriateness of the recognition of revenue from those transactions. Appropriateness of the revenue recognition of those transactions. So revenue recognition is an accounting term. It basically means you got in some cash. So something happened that gave me $100 of cash. Should the other side of that entry be revenue, or should it be something else? Should it be deferred revenue? In other words, not recognized into the P&L, but rather sitting on the balance sheet. What should it be? And there's a test for whether these things are revenue. And the test is, I'm not current on IFRS and the reporting, all that, but the test is basically, is it a legitimate transaction? Was it shipped? And are you going to collect the $100 because it generates a receivable? So this is not a collection issue, for sure. This is not because they probably already collected it and they wouldn't express it as a revenue recognition issue. They would express it as a bad debt issue. If it was a collection issue, therefore it's a legitimate transaction issue. It smacks to me of a risk of fraud, a la CAD-Trust. And I'm not saying it's the exact same thing. I'm not saying I even have any knowledge as to what happened. I'm just telling you the sentence in that press release that talks about revenue recognition says to me that there's likely something illegitimate that happened probably within one of their subsidiaries, and they don't want to, and it's material, and they don't want to recognize the revenue because they don't want to be sued after and accused of a bunch of things, properly so. And so they're just withholding their financial statements for a period of time. And they said, I forget what they said, 5 or 10 days or 15 days, I think is the cure period. So they thought they'd be done by then, but they're not ready. And then later in another report, I read basically the same thing, but that the forensic accountants are involved looking at this as well, which just confirms my suspicion that there's a fraud. So what's going to happen? I think my prediction is they're going to report within the cure period. There's going to be a significant write-off for revenue recognition. There's going to be a mea culpa on some shenanigans that happened somewhere within the subsidiaries. Just my guess, but that's what I think is going to happen. And I think they're going to take a hit. Now, are they really going to take a hit? They have so much money on the balance sheet. I'd love to be shorting this like CAD-Trust since bid last year and not believing in them, but they have so much money on the balance sheet. It's going to be interesting to see how this goes. I predict that they survive this, and it seems like maybe they're dealing with it appropriately. So we'll see. Let's keep an eye on them. Tilray's getting crushed, of course, but most interesting to me today was Canopy, yesterday's news. So Canopy announced that in an effort to align supply and demand, they're closing their cultivation facilities in Aldergrove and Delta, BC, eliminating 500 jobs, abandoning plans for a third greenhouse completion in Niagara-on-the-Lake, which is in Ontario. Looks like about a $700 to $800 million write-down, and analysts are looking at $4.5 billion of asset values being written down, which could be goodwill, intangibles, PP&E. Hi, the show was interrupted because my doorbell was ringing, and I received my care package from Roofers World, an Ottawa, Ontario-based company that I own, that Sinclair Range owns, and we got some of the products shipped to us, which is kind of cool. So I don't know if you can see this. If you're on the podcast, you're not going to see it, but on YouTube, you'll see this product is called a ladder mount, and it sits on your eave trough, and it keeps the gutters from being crushed, and the stabilizes the top of the ladder. A tool for roofers, and also for anybody with a home and a ladder. This is what they call the Red Ripper. So it's a shovel handle. This is a D-style shovel handle with a metal head that, if you can see that there, that is designed for tearing off shingles off of roofs. It's used like a pry, scoops underneath and pries out. That's been around for 25-year anniversary, I think, is this product right now. So I've been waiting for the shipment for quite a while. They got stuck in a snowstorm, but now they're out here in my house in British Columbia, and I'm going to give a bunch of these to roofers and spread the word, and maybe I'll do a little contest on social media for them. And also, I just wanted some of these around the house. They're cool tools. So sorry for that interruption, and I'm going to have to splice these videos together. But hopefully, you won't notice too much of a lumpy joining of the videos, if I can put it that way. So I was just finishing off on Canopy. The point of the Canopy story is that there continues to be a gross oversupply of cannabis in the market, in the Canadian market in particular. It's leading to asset write-downs, it's leading to continued layoffs, and this is not going to change. And I had an interesting little chat discussion on YouTube comments with a watcher or a viewer today about CanTrust and getting their license back and what's going to happen. And I just want to remind you, who needs CanTrust product? There's so much product in the marketplace. People are closing down their facilities, laying off people, and running off assets. When CanTrust gets this license back, who cares? They still haven't filed their financial statements. They still have the class action lawsuits against them. They still have the regulatory and the police after them on what they did in the past. They still don't have a good management team or much of a changed management team. The only thing they have going for them is cash. But I don't see, with a license, they're going to start growing. I don't see people excited about buying their product, and I don't see any need for it in the marketplace. So I continue to be against a bear, a short on the CanTrust story. Meanwhile, Canopy, who ousted Bruce Litton, the founder, however long ago that was, on the same day, Bruce is back in the news, launching his SPAC, a special purpose acquisition company in the U.S., I think to be listed on NASDAQ. Ultimately, I think they were going to raise $150 million. And he's doing that together with some other ousted Canopy people. The new company will be called Collective Growth, and its intent is to invest in the U.S. predominantly in the CBD and hemp space. And this is a good opportunity. The reason I raise this is a good opportunity to remind ourselves that entrepreneurs, management, owners, we all need to remember that the leaders of organizations are specific to situations when things are different. We've talked many times before about a troubled company leader. It needs to be a different person than a stable company leader. Canopy is a company in chaos, and they ousted Bruce Litton because it was out of control, and there was just no realistic opportunity for them to make money. That's just kind of the bottom line. And as I think Bruce himself said in the interview when he was fired, he says, "This is not the first time I've been fired from a company that I started," which I thought was a good line, by the way. He's a great entrepreneur, clearly, at launching businesses. He's not great at running mature businesses or more mature businesses when they get to a certain size. We need to remember that as investors, managers, owners. Know who your people are, know what stage of company and what challenges they're good at and what they're not good at, and make changes accordingly. My prediction for Collective Growth, I'm not sure. I'm going to watch it. There's a lot of capital behind it, but the hemp CBD industry in the U.S. is chaos as much as cannabis in Canada is chaos. I'm heavily into that space right now. I like it, don't get me wrong, but I'm not sure where it's going to shake out. The regulatory side is still a mess, so we'll see. I'm going to watch on that. Also in the news, continue to watch MindMed, and we spoke yesterday on the show. I spoke yesterday on the show about the importance of marketing the stock, your stock when you're a junior public company, when you're just starting out, a stock promote. And I noticed today with interest the difference between MindMed versus Shroom. Shroom being Shroom, the symbol SHROOM. That seems like too many letters for symbol, but anyways, it's Champignon Brands, and it's traded, I think, on the Venture Exchange. And so I recognize that MindMed took a hit. this afternoon in the markets and actually closed a little bit down, which doesn't concern me at all. But when I was looking midday today, their volumes were huge. They were another $14 million, 14 million shares midday, which is over $11 million at the prices that they were trading at in trading volume just today. A market cap of 220 million, not adjusted for their decline towards the end of the day. And they're up 300% to 400% just this week in a couple of days. Again, that's all based on mid-market information. And my proposition to you yesterday is you need to market your stock. It needs to be a separate asset from, treated separately from the business, and you need to have a marketing plan, which some might call a stock promote, to make sure that there's buyers. And if you're going to have buyers, you have to have sellers. So to make a market, you need to work on those two things. Now compare that to Champignon Brands, which I don't think is an apples to apples comparison in terms of company, but they are being considered to be in the same space. So the medicinal mushroom brands. They in turn, instead of 220 million like MindBed, have a $13 million market cap. And at the same time that I was looking midday at MindBed, the Champignon shroom had 7 million in shares traded for $3 million of trading volume for the day. And that's just a huge difference. And it just shows you the massive difference and an example between a stock that's organized and promoted and one that is not, even though the one that is not has a really tight float compared to the one that doesn't have the one that is promoted. So floats are important, but they're not everything. And I just thought that was an interesting example. Don't get me wrong, I went and bought some Champignon Brands anyways today. Okay, lastly, for the day, I just want to touch on the coronavirus from a business perspective. I don't want to talk about the virus itself and its health impact and all that sort of stuff. But I think if you're in business, you need to understand that the media today is driven more so than ever by fear. And I was frustrated maybe a month or two ago. I was looking at I forget which app, maybe the Fox News app, something like that. And they've changed all of their, yes, it was Fox News. They've changed all of their headlines. Instead of saying something specific as a headline like you would see in a newspaper of old, now even on Fox News, their headline says along the lines of, this senator, you won't believe what he did. It was this, in relation to this issue. So and I'm not making up this, like they don't tell you. You don't even get to know what the story's about until you click on that, because everything's about clickbait. It's all about getting click through on online, and the best way to do that is fear. There's a whole industry of fear these days, and the coronavirus to me is just a glaring example of that. So everything you hear, you need to take it with a grain of salt. So for example, they're reporting this morning that the death rate is well over 3%. I think it was 3.4. I don't have the numbers in front of me, but let's just call it 3% plus. And you have to ask yourself, how do they know that? What is the denominator of that fraction, right? The numerator is the people that died. Well, to calculate the percentage, you need to know how many people have this virus. And you have to wonder if we have any idea. We know how many are reported, so maybe it's 3% or 3.4, whatever the number is, based on the reported cases. But we also know that this virus has, in some instances, some very mild symptoms. People have a cold-like symptom, and they're not going to the doctor, and they're not being reported. So be skeptical of these sorts of stats when you combine the motivation of fear, which is tied to greed, because you're looking for clickbait and you're looking for viewership, and you combine that with just a bunch of made-up numbers. When I don't know what the right number is, you don't know what the right number is, and the experts have no idea what the right number is. It's just a made-up thing, and you shouldn't be making decisions in business based on these sorts of stats. Are supply chains affected? Definitely. I got my tools today, as I said, from Roofers World in Ottawa, and some of this, not all of it, some of it is made in China. We were fortunate. I want to say it's good planning. But it wasn't. It was just lucky. We actually, this virus hit shortly, actually right in, but at the tail end of Chinese New Year. And so we had built up a bunch of inventory in the factories in China because our demand is growing and our needs are growing. And, Chinese New Year's is always a crapshoot as to who's going to come back to work and when the factories get back up and running. So we built up a bunch of inventory in China, and so our factories were delayed a few weeks getting back up running. I understand they're back up running now. We'll have some shipments on the water shortly, but we built up enough just by good fortune that our supply chain was not materially impacted, and we're not going to have any back orders because of it. But definitely other people's supply chains are being impacted. So there's an article from Apple today where they're warning their distribution, their retail outlets, that they're not going to have enough phones in all likelihood, and that they're going to run out. So let's just take for granted that there's supply chain issues, and therefore earnings on these companies will be hurt by the coronavirus. And that impacts value, and that impacts stock price if you're an investor. So what does that mean? I always think in my head of a discounted cash flow model, and you've got month by month, a quarter by quarter of the cash coming out of the company in the future, which is the definition of value. And if Q1, if the quarter that you're in right now sucks, and the next quarter that you're going to be in also sucks, you're discounting for time and you're discounting for risk. And so the most immediate quarters have the most impact on value, whereas something that's 5 years out really doesn't have you can change that to up a lot, down a lot. It's not going to have a hell of a lot of impact on the valuation of this company, because by the time you discount that for time, it has very little influence, whereas the early quarters in that model certainly do. So they're going to be bad. And so there's a legitimate mathematical killing of value as a result of supply chains because of the coronavirus and their lack of decoupling out of China and the other places that they're getting manufactured. But I ask you, do you think that the demand for these iPhones is going to go away? Do you think if you can't buy one today that you're going to not buy an iPhone 3 months from now when the supply chain is back up and running? This is a really short-term thing, and I don't know if that means 3 months, so 1 quarter, 2 quarter, 3 quarters. My suspicion is it's a 2-quarter issue, but that's just a gut feel. So don't hold me to that, certainly, but the demand is going to come back. And when the demand comes back, discounted cash flows and valuation models don't deal with the past. They only deal with going forward. And so you're going to have a surge demand in Q3. If it's a Q2 issue, in Q3, you're going to have a surge of demand. In Q3, Q4, people are going to be buying a bunch of stuff to catch up for what they didn't buy 2 months ago. And these stocks are just going to, from a value perspective, just jump right back to where they ought to be. Something to think about. Don't be overly frightened. Don't worry about supply chains too much. To me, I don't give you this investment advice. I'm not qualified. I'm not selling you anything. That's not what this show is about. But I think if you're, the way to think about the business side of this coronavirus is that, yes, there's a hit on shareholder value today, but that hit's going to go away and it's going to come back stronger than it was. And I don't think that's going to take very long. Thank you very much for listening. Martinis with Scott. Episode, what did we say? Episode 44. I have to get used to this new numbering system. A show about winning at business. And please subscribe if you like the content. It helps out a lot. Subscribe on YouTube, Apple Podcasts, Spotify, and hopefully we'll be back at you tomorrow.